Welcome to Wednesday webinar. Tonight we're coming to you from the Sydney Olympic Park where the Royal Easter Show is being held. I'd like to discuss with you how the margin scheme works. This will save you a lot in GST if you're selling vacant land, residential new home or substantially renovated new home. So you get the same amount for the property regardless of whether you have to pay GST on the sale or not. It's just whatever the market will wear. So if you can reduce the GST by using the margin scheme, that's money straight in your pocket. You can use the margin scheme when you've purchased the property from when you purchased it, that contract was under the margin scheme, or when you purchased the property where it's an established residential property, so there was no GST in the contract because GST doesn't apply to established houses, or where you bought the property before the 1st of July 2000, which is when GST came in, or where the person you bought the property from was not registered for GST, so there was no GST in the contract for that. You cannot use the margin scheme when you've just had a normal sale where GST applies, or where you use the going concern clause in the contract, or when it's primary production, the concession for primary production land that changes hands. Now, the margin is the difference between the price you originally paid and the selling price. That is the margin that GST applies to. So when you normally sell a property, 1/11 of that property selling price goes to the ATO and GST. If you can reduce it to just that margin, there is a huge savings, so well worth looking into. The margin scheme simply means that the GST is not 1/11 of the sales price, but 1/11 of the margin between the base cost of the property and the selling price. So it's the selling price less the base cost, then you divide it by 11 and that tells you the GST payable. In this example, we've said that the selling price of the property is $500,000. Originally, the developer paid $170,000 for the block, for the land, and that qualified for the margin scheme. So there's $330,000 that is the margin, and 1/11 of that is $30,000. That's a lot better than 1/11 of $500,000. Now, the base cost depends on when you purchased the property. If you purchased after the 30th of June 2000, it is the original price you paid for the property. If you purchased before the 1st of July 2000, the base cost is either the market value at the 30th of June 2000 or the market value when you first registered for GST, if this is a later date. Now, how to make the contract subject to the margin scheme. It is important that there's a clause in the contract where the purchaser agrees that the margin scheme can apply. If you don't put this clause in the contract, you can later apply to the ATO for an extension of time for that agreement to come into play, but you've got to then find the purchaser and get them to agree. So please, before you enter any contract where you think that the margin scheme may save you some GST, get some advice as to whether that will apply and get the clause in the contract. Don't think that you're going to fly under the radar, that the ATO won't know. If you sell a newly constructed home, a substantially renovated home, or vacant land, expect the ATO to come and ask questions about whether the GST applies. So get advice first before you enter into the contract, because by the time the tax office comes asking questions, many years will have passed. Thank you for staying to the end, and I hope to see you next Wednesday.